Okay, I think we have a pretty good group already. I'm sure people will continue to trickle in. Hello and welcome to RedeConnect webinar on sustainable franchise growth. I'm Nikki Ruklich. I'm head of Rede Strategic Advisory Services, and I will moderate today's panel. Just before we get started, I wanted to make everybody aware that we're doing this under Chatham House rules, and so none of this will be posted or referenced publicly in any way. So basically what happens at RedeConnect stays at RedeConnect. As the GPs are facing growth pressures from many different directions in today's environment, their LPs are looking to deploy larger checks. The need to access a broader range of deals is increasing. There's a desire to create opportunities for the next generation of talent and to capture greater operating leverage. So these pressures for growth are often exacerbated by frequently cited views in the media that the largest asset managers will consolidate the vast majority of global capital while the rest ultimately lose relevance and disappear. So how do you grow your franchise sustainably? We are very fortunate today to be joined by a terrific group of private market leaders to discuss this topic. We have Freddie Allen, director at Temasek, focused on private equity funds, co-investments, and secondaries. Gustavo Cardenas, managing director at Wafra, focused on strategic partnerships. Bjarne Lie, founder and managing partner at Verdane, and Mark Tognolini, co-founder and co-CEO at Hafen. Thank you all for joining. Let's start by looking at what drives the growth ambitions of a GP. Freddie, we'll start with you. How do you assess the GP's motivation for growth when looking for a new relationship?
Thanks, Nikki. So look, our first questions are typically why, what, and how a GP will grow. Where's the desire coming from and who's driving it? And that could be internally, such as managing partner or managing partners or a subset of partners, but could just as easily be driven by a large strategic LP wanting to deploy more capital in a specific area. So if we put to one side just a pure scaling in fund size, which LPs so often see, I'll perhaps comment on additional strategies. And the four areas we typically try to assess are firstly, the GP's right to win. Will this become a sustainable pot of capital that can generate fee and carry going forward? Secondly, and you touched on it earlier, the personnel retention piece is really important. Is this strategy being launched to grow a GP's people and create leadership positions for them? A third area is this capitalizing on an area of expertise that the GP has and deal flow that the GP is seeing, but perhaps doesn't otherwise have the fund architecture to prosecute? And then the fourth area is, will this be a distraction from the bread and butter business? If you want to sustain franchise value longer term, you can't afford to leave behind what made you successful in the first place.
Makes sense. And Gustavo, what growth ambition context do you look for when assessing a new partnership?
Yeah, and for context, we're a minority owner in over 30 private markets firms across North America, Western Europe. When we look at a situation, a lot of what we're really focused on is what makes that GP a leader at what they do. So it brings up some of the same topics that Freddie was talking about, but really focused on why should LPs be consuming this product? Our question really starts there. And because we're not only making an initial investment, we're helping the long-term firm growth. For a lot of folks, the growth of the flagship fund is the first, second, and third priority. And that, I think, needs to be supported with a lot of the data of what is your pipeline, what is your deal size, what is your really ability to grow in a way that will sustain returns, because that is your main area of focus. That being said, some of the other points around team growth as well as strategy expansion that might be potentially protecting your core area, where to the extent that you are a great healthcare equity investor and you want to launch a credit focused strategy that might help your view of the credit markets in that space, that argument needs to be fleshed out. So that is something that you should have dialogue with your LPs early. And as well as then understanding what is the long-term path of firm succession and firm leadership, not just who is there today, but who might be in the long-term ownership of that firm. Last thing I'll say is something that people are less focused on, but given the audience today, I think quite relevant. What are the tools that you will need beyond the investment side to accomplish this in a way that it doesn't become a distraction? Not just, sometimes people think about hiring a great group like Rede or an investment relations professional, but your chief compliance officer, your chief financial officer, all of these really important folks within the firm that are not necessarily front office, but that are quite important so that the execution of a different strategy doesn't take away from your core business.
Thanks, Gustavo. It sounds like the common theme, what I'm hearing from both of you guys, is that there's really a need to protect that core of the manager and really understand what is that makes them special and ensure that none of the growth avenues that they're pursuing jeopardizes their ability to continue to focus on those matters. Important thing to keep in mind. So as GPs pursue their growth ambitions, they increasingly need to think of themselves as a business that needs to build value, especially as LPs expect them to have an increasing amount of skills and tools, and all of that costs money. So minority stakes and other forms of financing have become an increasingly important topic, and one, Gustavo, that will stick with you. You're obviously at the center of many of those kinds of discussions. So what's your pitch to the GPs as you think about forming those partnerships and accelerating the growth in the ways you mentioned?
I think if you were to create the ideal minority owner in a vacuum, you'd want it to be a set of asset owners that are going to be consuming the product created by that private markets GP over a very long period of time. And that's a bit of how Wafra started our own business, where our parent company, the Public Pension of Kuwait, was a backer of several of the groups that we had minority ownership in. But over time, through our capital constellation vehicle, which is focused on 0 to 5 billion of AUM managers, has been able to attract other large asset owners across various geographies and asset types. So today we have a pretty concentrated set of 20 different LPs that we have interactions with, not just those institutions, but typically CIO, deputy CIO, heads of private markets, that when we close a transaction with a GP, we are physically putting them in contact with those groups. And it won't be that necessarily everybody will be backing you immediately in that vintage that you're raising. But I think that the idea of what Wafra and Capital Constellation is trying to create is that there might be folks that are going to be early on in your journey. Over time, there might be folks that are looking for mid-market allocations. And then over the long term, there are some of the largest asset owners in the world that are within our network that might be looking for strategic partnerships at the 200, 300, $400 million level. I had dinner with one of my GPs, actually also a Rede client, and they told me that a fourth different asset owner within my network had recently joined their LP base in a 4-year time frame, right? So these are multi-year relationships that we're focused on continuing to grow. That's the first, second, and third thing that we do. I think that the perspective of somebody who's seeing the market in a way that's not just on the deal execution is also highly value add, and we have other value add capabilities. But if you remember, one thing about Wafra is that across the 30 GPs we've backed, we've been able to generate over $12 billion of non-contractual capital to funds, co-investments, and secondaries managed by our GP. So we're very proud of that.
So let's hear the other side of this argument. So Mark, you have gone through a number of transactions with Hafen, a number of partnerships. How do you think about picking your partners, and what makes a good one?
So you're right. We set up 17 years ago. Ultimately, the blank sheet of paper. We have focused on organic expansion, and the institutional partnerships we had have helped us evolve. I say partnerships because our learning, in essence, has been that as we've evolved, the answer to which partner do you pick and for what purpose has been something we've confronted a few times. At inception, 2009, on the back of the global financial crisis, setting up a European credit manager, what did we need? We needed bravery. We needed capital, scaled capital support. And we wanted to build with someone who looked at it as a long-term enterprise. So we had a contrarian investor in terms of Towerbrook, who opened their GP roster to co-investors, which is fairly new, believe it or not, in 2009. And we had huge scale in terms of the capital commitment to put in place the talent that people on this call have just talked about. to paint the vision and actually to develop track record with that capital over the period of ownership with them and build out our flagship offerings, which is touched on at the top of the call in the private credit space. So that was chapter one. And the reciprocity was that we owned a small amount of our company, but with a big vision and an ability to capture that through time. Chapter two, 6 years later, actually picking up on Gustavo's point, we were looking for a partner that we could build our platform in terms of the adjacencies. And we partnered with BCI I would think about as a client first and ultimately a shareholder. And capital support was what was key to us in that context. The reciprocity, which is what I like, is the alignment around investment return for them. And actually, they're establishing parts of private credit in their benchmarks. Chapter three, to round it out as to where we are today, and this is 2024, was finding an exit for BCI, but at the same time, thinking about how do we grow our current footprint, our perimeter. It's not so much the extension of what we have, but building on what we have. And that required for us a different solution, one that provided stability to our current LPs, of which there are many and varied, and that they would be comfortable with, fair value for BCI, support for our vision as a team, and could help us with an MBO. That's where we ended up. We went to what I would think about as a GP stakes partner on a sophisticated basis, like the colleagues on this call, which was Arctos. And what they put in place for us solved two things. One was a novel way of the team owning the majority of the business. And the second actually was giving us time, having closed that deal, to bring in some strategic capital partners, which for us were Mubadala, Samsung Life, and AXA, which enabled us, if you will, partners with that extra capital support to grow into the future. So all various components of the equation, and actually what was needed at each stage through our evolution has been different and has been very additive.
Are there any common denominators between all of these different partners that made them that good partners?
Were there common denominators?
Yeah.
Yeah, I think in each case, an understanding of what we were looking to build, either because Talbrook was a GP, Arctos is a GP, and what's involved in terms of the kind of risks and the journey, and where we had real capital support because they're a client. And so if you think about that alignment and the value that comes from looking at it through that lens, there's a meeting in the minds in terms of what's sort of critical for success.
Makes sense. Thanks, Mark. Thanks, Gustavo. Moving on to another important topic under consideration for franchise growth, which is platform extensions. And we've already referenced some of that early on, and we have seen a proliferation of GPs entering new products and strategies as they look for growth. So Bjarne, Rede has been very successful with platform extensions. Can you tell us a little bit about how you think about growing the Rede platform whilst protecting what made that initial strategy so special?
So I think it starts with what Freddie said. Is there a right to win here? And we sort of, the fundamental question we ask is, do we think we can generate sustained strong returns on alpha across multiple cycles if we do this? And then we look at the things Freddie talks about. Is there sufficient sort of market opportunity here? What's the supply and demand of capital? Does what we do mean that we're credible to win in this space? But then we ask a separate and really important question is, well, if we do this, will it actually strengthen our existing our existing activities, or will it detract from them? And so that is where most of our great ideas have gone to die over the last 20 years, and where we keep coming back to is what we think we can offer is sort of disciplined access to growth in the lower mid-market in Europe, and then be the best possible active owner to those businesses. Sort of summarize and simplistically saying, so is 1 + 1 bigger than 3 if we do this? And then the next question, and I think Gustavo touched on that very eloquently, saying, well, if your investors don't agree with you, then you should probably not do it, right? So And in our world, that means basically your existing investors agree. We have never done this sort of, well, you can get into our oversubscribed core fund if you participate as well in this other fund, because we think that you don't then have a sufficient sort of intellectual rigor behind the underwriting on the investors. And I think that's a great sort of stress test of your thesis and your work, because the LPs sees the world from a very different perspective than you do. But if you answer that question with a yes, then of course the hard work begins and you have to execute. And we've done certain things, I think, a little bit differently than many others. And one is around incentives. We have ensured that we win and lose together. Our belief is that in this industry we have focused too much on the individuals incentives, and perhaps as well too much on the individual sub-strategy incentives. So we try to create a broader incentive pool and invest a lot in the culture and our values around that, bringing people together, travel, deal teams across, sort of cross-fertilization. But then I think also super importantly, and perhaps to wrap up, if we do this, you have to, or when you do the platform extension, at least the way we thought about it, you can't fail. You have to commit fully. And that means that Rede, we very proudly have no flagship strategy. And the same way we never have had a headquarter in our business. We're sort of born international. We don't have a flagship. And I think that's where perhaps for some it's become a distraction, because it's become that sort of something you do on the side, and if it doesn't work, it's okay. For us, we will sort of say, okay, if we do this, we need to make sure it works.
That's a great philosophy. And Freddie, what proof points do you look for then when you're deciding whether or not to back a platform extension product or strategy?
Yeah, look, I think assuming we've gotten comfortable that the platform extension serves a purpose and addresses a need, and that the firm's past track record and market opportunity set support it. One of the key areas we look at is firm architecture, as there are three broader themes that we've seen with failed products. I think these are: one, the new product being viewed as subordinate to incumbent ones. Perhaps this goes to Bjarne's last point there. Secondly, products being run by the good but not spectacular B teams within firms. And the third sort of theme is a limited number of internal champions within the senior team of a firm. And with it, there's some degree of key man risk in some cases if those senior champions either retire or roll off. Beyond that firm architecture piece, there are two other things we sort of look for. The first is the firm's ability to put a coherent story around a new product, to allow them to continually raise capital. And secondly, skin in the game. Is this meaningful relative to the firm's other strategies? And put differently, if this were to fail, would it be sufficiently uncomfortable for the GP? This is an alignment industry at the end of the day. So we want GPs to be sufficiently bought into the strategies they're running.
Thanks, Freddie. And I forgot to mention at the beginning, to everybody who's joining us for the webinar, feel free to use the Q&A function to type in any questions that you have for our panelists. The questions will be anonymous and we'll be able to see them. And if we have time in the end, we'll address them. But going back to the main discussion, 5 years ago, Adam and Gabby at RedeConnect predicted that the industry will evolve towards a wave of IPOs, GP staking, and then consolidation. And it seems that the consolidation trend is coming to fruition now. So, Mark, going back to you, given all the transactions that you've been a part of, how do you think about protecting that secret sauce around the firm culture and that original strategy, whilst also capturing the benefits of the deal?
Sure. I guess people have touched on this call. It should be obvious in our space, but we're a human capital business. If you think about the COGS line item, and talent is core. Our special sauce, therefore, is being joined up as an institution. If we think about having a European platform where we want to be the eyes and ears in the context of our solutions, which span from high yield to supporting GPs in terms of some CVs and so forth within markets, so it's pretty broad. We need to be on point in terms of why it makes sense in terms of platform capability, but we need to kind of encourage a collaboration and that we get the benefits of research synergies on our platform and the relationships, because Europe's a broad market, we're local in different geographies. So how do we make that happen organically, or even where we've had different teams be part of our platform. I think it comes back to reward and incentives, because that's the way you reinforce the culture, was said at the top of the call. For us, we don't operate a multi-boutique platform. That's not the way we think about it. In a kind of consultancy realm, it's the one Heathen sort of ethos that we want to encourage. I talked to you about the fact that we have done an MBO. We've got 140, about 270 professionals own shares in the business. So if you think at the top of the firm as owners, you may be in different strategies, but ultimately you're swimming in the same direction. Certainly in our MD pool, the equity is a great tie-in from that standpoint. We share carry across our different mandates so that there could be skews, but ultimately, as was said previously, people are focused on performance across the business and a level of consistency, working with one another to actually think about where that solution could come from, rather than being jealous about which pocket it goes into. And I think an institutional mindset in the context of if you're building as we have done for 17 years, and the future is about getting succession right, which we've had to do through time, and where everyone's a stakeholder. And so for us, LPs want stability. Frankly, that's the value equation for us. So as we would analyze organic growth and the challenges that can bring in our journey, but even if I think about it through the lens of what M&A is quite difficult in this space, I think it comes down to reinforcing that kind of culture and having to kind of tick the boxes in the areas just described as to how to make that happen. But certainly from a consolidation perspective, I've been advocate of the theme that we've seen for so long, as much as it's going to continue. And I think your question as to how do you kind of make sure you preserve what's good will be the continued challenge as people evolve.
Thanks, Mark. And then Bjarne, going back to you, you have not pursued GP to GP M&A as part of your evolution so far. What would convince you to do a transaction like that?
It's interesting. We have also not taken any GP stakes or any sort of third-party financing. I think a lot of that for us is we are sort of obsessing about creating alpha and absolute returns, and we're worried a little bit about if we think too much about the GP as a business and focus too much on fee-related earnings. It's a hard battle, and a lot of people have done it very well, but it makes it even harder to stay performance-focused as you grow, I think. So for us, M&A ultimately would come down to buy versus build. We've invested a lot in technology businesses over time, or technology-enabled growth businesses, and they always have on the board saying, well, we have this fantastic opportunity. Do we buy it or build it? So sort of following on to what I talked about before, what we've considered before when we've done a platform extension, is this opportunity? Do we have the right to win? Can we generate returns? Do our investors agree with us that opportunity set is there? And then, how long will it take us to build or spin out the team organically versus can we actually buy someone that can, shorten the path to market or shorten the path to the market position we want? I think that is our mindset around it. So I don't think and whether that takes the form of an acqui-hire or acquiring a more established franchise, I think that's both the things that we sort of are considering on a sort of ongoing basis as we, on a steady path, want to continue to develop, whether it's a geographic or it's a sort of something that's very close to what we do today. But and that's, I think, is the only context in which for us taking on some sort of third-party financing can be relevant if we needed capital for that. But it comes down to performance and alpha ultimately. Will 1 + 1 be more than 2 or not?
Makes sense. And Freddie, what kind of deals do you find exciting and accretive when you see the M&A activity?
From exciting and accretive. Look, if there's a way for a GP to access an attractive strategy where its heritage is relevant and it can synergize with an existing strategy of another firm, then it can make sense to buy another GP with that strategic expertise rather than building de novo. Obviously, we've all been reading the papers recently. Good example might be Arctos and KKR, the tie-up there. Obviously, Arctos are well known in sports. They've got a unique understanding of how that type of strategy works. KKR don't yet have a strategy like that, but have an immense distribution and capital formation infrastructure that they can just plug it into. By acquiring rather than building de novo, it doesn't come at the expense of a firm's existing strategy. So it's not like you're taking, I don't know, high quality deal leads from a media team, for instance, to launch a new product, at the expense of an incumbent product. So as an LP looking outside in, I think the key for any firm level strategic M&A is that the target needs to be established and credible. But also it's got to be far enough away from your bread and butter to justify going the buy versus build route, but also to ensure that you're not cannibalizing on an existing strategy. So that's the way I think about it in simplistic terms.
Thanks, Rede. And so if you think of looking into the future and the market is evolving and changing rapidly, demanding evolution and creating those growth opportunities, I would love to get everyone's take on sort of what lies ahead. So we'll start with you, Gustavo, if that's okay. What do you see as the top growth priorities for the GPs in the market overall, and especially for the ones in your portfolio?
Yeah, I think that if you read the financial press, you hear about consolidation, you hear about wealth, you hear about all of these different things where the thing that GPs have the most control over is the processes and their go-to-market that will differentiate them. I think that one of the things that I personally think about when I think about GPs is what makes them different. What's like the one sentence overview that is they're the best investor in this industry, or they source in this unique differentiated fashion, or they're the category leader in that geography, right? So making sure that that moat is incredibly defendable makes it so that you can build on that. And more than distribution channels or otherwise, to the extent that you have, there are two things that are the hardest in private markets: accessing transactions and accessing investors. I think that the investors are really looking for those that can access interesting transactions and generate value. So if you can create that repeatable moat, you can then grow on top of that. And there's a lot of noise around consolidation or distribution. Those are things that are more outgrowths of success rather than the strategy that in and of themselves.
And if we hear from Freddie, from you on the market sort of in general, we've sort of started by referencing some of the chatter in the market around the bigger are getting bigger and they will sort of swallow the world, and everybody else will struggle. What is your view on how the industry will actually evolve?
So look, my view is a little more nuanced than the big get bigger and everyone else toils. For sure, in the medium term, I think the larger listed names will continue to capture AUM, with a lot of that driven by retail capital, particularly if 401ks come online in North America. If you're listed, you're clearly motivated to move earnings per share, and so capturing FRE is going to be a key driver of that. Hence the huge opportunity that retail presents for these large listed guys. My 5 to 10 year view is that I think you'll start to see more of a bifurcation between the retail and institutional PE segments, not just in terms of return expectations, but also the way in which stakeholders interact with it. Industry and regulatory bodies interact with those distinct parts of the asset class too. So in the meantime, as distributions have slowed down and returns expectations have compressed across PE, there'll be even greater scrutiny from institutional investors like us and like others, about where they deploy that incremental dollar. It's fair to say that table stakes is robust through the cycle returns. There'll certainly be consolidation, shakeout of GPs who struggle to capture that incremental dollar. Although some of the structural engineering that you started to see through continuation vehicles and the like will lead to basically a higher number of zombie firms over an elongated period, and we're already starting to see some of that play out. If I were to then draw these slightly disparate themes together into just a broader conclusion, and I don't want to monopolize the mic here, it's sort of this: institutional capital will always be motivated by realized returns and DPI, and for that, exit optionality will remain absolutely key. yes, the large listed guys have arguably the best halo effect, the biggest distribution teams, the biggest capital formation manpower, which is obviously going to be really important for the retail side of the asset class. But at the end of the day, at least from my perspective, you can't CV a $15 billion company. So you're at the whim of public markets when you get to scaled assets as a liquidity REIT. This is going to be a really interesting consideration for many retail and semi-liquid products once they hit scale maturity, and hence my point around the bifurcation between retail and institutional. It's not it's converging for now, but I think over the medium to longer term they'll become more distinct.
Thanks, Freddie. And it sounds like Freddie also listened to the Review webinar beforehand, so highly consistent views with a lot of things. Thanks, Freddie. And Bjarne, when you think about Rede and sort of the next 5 years, what are the most important growth considerations for you as a team?
I think first of all, let's sort of align and agree, because there's not always an agreement around that. That growth, I think, for any firm in any industry in any cycle is good, because growth creates career opportunities. It's sort of, there's one thing I've learned after having worked for 30 years is that it's more fun when you have growth than when you have decline. So we certainly want to stay on a disciplined growth track. And to Gustavo's point, I think he said it really well, right? So you need to make sure you have the investor support. We have thankfully been oversubscribed at our last 9 races, including all 3 strategies now after the market's turn, which is great. You need to access the best transactions, and I think we are where we want to be there as well. With we have over 4,000 people at our events every year, and we have a deepest growth portfolio in Europe. I think where the industry needs to continue to improve, and we were early trying to build our in-house tech team and an in-house DevOps and Ops team, sort of 6-7 years ago by now. But I think that sort of the third piece of what Gustavo, I think probably, at least to my mind, should have said is make the absolute most of what you have. Make the best possible active owner you can be. I think there's so much we can do now, both around AI and around the data we have in our ecosystem. And we have this Elevate in-house 30 people ops team. And I think there's so much more we as an industry, and I don't think we'll ever crack it, but I think we'll get a lot closer in the next 5 years to try and figure out what is the best engagement model to make the most of. Once you have access to the capital, access to the best transactions, how do you actually make sure you create alpha as an owner? And then that's an area where we're investing a lot of time and energy and capital into.
Great. Thanks, Bjarne. And Mark, same question for you with regards to Hafen and the future growth focus.
Yeah, so as I said, having just completed our MBO, we're pretty clear on our internal focus, which is around the current offering or perimeter of products that we manage. If I think about that, we have the reason that's exciting is that each of them are at slightly different stages in terms of their evolution and the market opportunity. There's a kind of common nexus as we would think about it in terms of our sort of right to win and moat around it. There's track record and sort of summer and earlier vintages versus latter. So, if I thought about, we have a tactical credit offering that right now is going to be a way for us to have a more scaled approach to the opportunistic market in a kind of broader European credit sense that picks up a lot of what we're doing on the asset-backed side, as well as cash flow, and kind of that intersection is where we see growth. We've got a maritime offering, which is a bit off-piste in terms of other aspects of institutional kind of product, but for us as a scale marketplace where we feel like we're a first mover in bringing institutions into that domain. So there are legs of our stool which, from an internal perspective, kind of align around origination, capabilities, driving hopefully the alpha and differentiation that the LPs want, and a bit of a blue sky kind of context in terms of some of those marketplaces. If I reflect on like the challenges, but also the ways to differentiate, I think as you kind of grow as a manager in the current environment, I think that we'll see more emphasis on enterprise risk and enterprise risk management as sort of firms grow, and what that entails for for platforms, and there again, obviously, kind of interlays with regulatory and other considerations. But I think the way you kind of risk manage your organization is pretty paramount. I think from a capital raising perspective, not everyone can put a 400-person retail team in place. I think that is one of the things that bigger platforms can bring to the table. But if we think about the most valuable component of growth in our business over the last 4 or 5 years, it's actually been able to put in place a scaled relationship management and client service proposition. Because for us to make sure from an LP engagement standpoint, we're doing the right things has been the kind of foundations for further growth. And I think that's a pretty key piece. I would also say that if you're in an institutional management realm, the kind of platform services that accompany investment businesses is, as you have complexity and you get asked for more things around SMAs and other considerations, are going to feed back into that enterprise point. Like it's a big business to run around the investment side. Performance is required, but not letting oneself down in other ways is sort of part of the puzzle. So, if I think about the skew of our resources, more than half of our resources are committed to client and the kind of platform to support the investment effort. I think that is something to be focused on, but also something that I feel you can differentiate in a way going forward. Last point, I think we're all kind of grappling with what data you have that's unique, particularly in private markets, and how you continue to generate insights or be able to articulate your alpha proposition in a kind of through a long-term lens. And I think that's just an industry focus where I'm sure we're all at kind of different stages, maybe even some cooperation at some point. But, yeah.
Great, thanks, Moore. We have one question that came in on our Q&A chat. I'll just read it out, and then I think maybe Gustavo, perhaps you try and take that one, but others feel free to chime in as well. What different considerations exist for a minority stake when the management company is essentially 100% owned by a single founder? It seems that a clearer path to succession and diversification of economics would have to exist before a stake is proceeded for numerous alignment, retention, and growth reasons.
So that's a very good question. I'd say that that's somewhat prototypical of a classic first-time GP stake. So something that I think the market doesn't really understand is that once somebody does a GP stake, I think of that as the start of their journey, of thinking of their firm as an enterprise, as Mark artfully laid out in the Hayfin history, where typically it's here in the US, 1 to 5 people are potentially owning the entire business. In Europe, it tends to be a little bit more democratic, and maybe 5 to 20 individuals are owning that. So rarely do you see the single founder, but then what we require from that single founder, or through 2 to 3 people that we might be engaging with, is to set in writing a succession plan. So I think that something that the market also underappreciates about GP stakes is that, at least how Wafra executes on them, is that we plan to potentially hold on to that business for 10, 20, 30 years. And for that, we need to understand exactly what the succession plan is, and not, have it pointed to in the long term. We really want the people that are leading the business to be the controlling shareholders of that business. So it can take many forms, and we don't impose our view of that. But that is something that we help start. And then the other part is that through the transaction, what we've seen is that a lot of folks are starting to bring in the next layer of management into larger amounts of GP commits, as well as structurally being able to show them, hey, this is the value that I'm bringing you into, sometimes at a discount or otherwise. But those are some of the considerations for a first-time GP stake. We've then seen folks iterate from, all right, well, I like having an outside shareholder. I want to be investing more in my business. Maybe I should raise $200, $300 million of primary capital to, if I'm investing into a new strategy, to show that we're all investing into this together. Or potentially, we've also seen the situation where we've executed a lot of our value creation initiatives, and some of my peers in the GP stakes market are saying, hey, I can also do this for you. So having people that are helping you so that you yourself are not distracted from the day-to-day is a reason why folks might want to be bringing in not just one, but potentially over time, multiple minority owners.
Thanks, Gustavo. I don't know if there are any other perspectives on the question, but if not, I'll move on to the next one. I've got one for perhaps maybe we start with Mark and Bjarne. What would be your advice to your younger self as you embark on the franchise building journey?
We don't have enough time to talk about all the things we have done wrong. No, I think it's in a fascinating way. We started life as sort of direct secondaries, being a portfolio solution provider. And I think to Gustavo's point about being very articulate about where you are unique, I think we almost did that to a fault. Because we are doing this, and then we sort of forgot to talk about, well, we actually do all these other things as well. We think equally good to everyone else, but this is one unique part. And I think we almost over-indexed on that narrow specialization to the point where people start to question our ability to scale, our ability to do all these other things. So I think sort of, yes, I think Gustav is dead on and be very, very articulate about your point of differentiation, but don't overdo it to the point where people think you're so niche that you can't really go anywhere.
Thanks, Bjarne. Mark, you bar's high. You've had a chance to think about it.
Yeah, wow. Look, I think we learned a lesson pretty early doors about this, appreciating where it is that we have an edge. I think it was a consultant that used the expression USP, and we had to look it up. But making sure that we had a sort of lens on how we wanted to grow the firm that was cogent and felt like it hung together. That gave us a bit of a true north. And we had a few situations where we were perhaps looking to go in directions that in retrospect didn't make sense. So that was learnt rather than but advice I would give elsewhere. I think the culture for us is something that we had in our very first pitch, and really kind of what do we want to foster as an organization, the people that we have, the firm. I think that becomes a bedrock actually in terms of the way in a people business that you need to consider that as frankly a very powerful kind of quotient for a force multiplier in the way that you sort of grow. And I think the last thing that I remind myself, and I would advise one's younger self, is it's a privilege to be part of a kind of growth story and to be working with very talented people along the way. And at times you can kind of forget that or get distracted by the different things that cause you consternation along the way. But I wouldn't change anything.
Wow, thank you. Very, very sage advice. Well, we're getting close to the end of our time here, so I want to thank you all for sharing your views today and for a great discussion. Growth is increasingly an imperative for private market managers and often a consequence of success, like we discussed. And as you heard today, there are many ways of approaching franchise growth. But what sets apart the franchises that really will stand the test of time? They have clarity of ambition. We've heard it over and over again today, a clear articulation of what makes them special, or USP to speak consultant, and focus on leveraging and protecting those differentiating capabilities. So thank you again. That's it for RedeConnect today. And we hope you will join us tomorrow and Thursday for our discussions on global capital flows, climate and impact, succession management, and building a modern credit manager. Thanks, everybody.
Thank you.
Thank you so much.
Thank you.
Thank you.